Getting ahead of 99% of the people means you have to think differently than 99% of the people. So let's test this hypothesis. Can you tell me how much money you will have when you retire? Go ahead, think about it. Because we didn't know. When we were contributing to our own 401ks, we had no idea how much money we were contributing. We just knew every month we put money in this account and we hope that some money's going to be there when we retire. So let's talk about how to plan for your retirement. My name is Carmen.
And I'm Darius. And the majority of Americans have something called a retirement account where they store their money in this warehouse where supposedly when they retire, they'll have this big nest egg. Well, however, what happens is life happens. And when life happens, we have to borrow money for emergency. We have to borrow money to take care of something that happened. We have to borrow money for whatever reason. We have to borrow money on top of the fact that the market does this thing where it goes up and down, which also affects the growth of our retirement accounts. So all these things go into affect how much money we have. Now, when we sat in that room with the HR department and they told us that this is the average rate of return that you're going to receive in your account, well, they didn't tell me that the average rate of return is different from reality, because that money that goes down, we have to make so much more money for it to come back up to where it was. Now I'm sitting here looking at my retirement account like this is different from what the packet that you gave me.
The packet is
different.
We all know what that packet is. Now, with that taken into consideration, let's also talk about taxes, because we don't talk about taxes and how this can affect what we go home with. Remember that money that I was asking you what you were going to come home with? We didn't talk about how taxes plays a part into that. So let's go ahead and put a disclaimer out there first and foremost. We are not retirement professionals. We are simply here just to give you a good understanding and knowledge, educational purposes only, as far as how these kind of accounts work, so that you can get the general information that you need in order to make informed decisions. Okay, so let's talk about taxes first and foremost. I want to talk about pre-tax dollars versus after-tax dollars. Because I know, again, when we were getting our 401ks, they were using these terms. And for me, I was like, yeah, I understand. But I didn't really...
Tax deferred.
Yeah, I didn't have the knowledge. Understanding and knowledge are two different things of what that really meant and how that was going to affect me. So pre-tax dollars means that anytime you put money into an account, you are not going to be taxed on the funds. Right? So let's use simple numbers. If I put $100 into my account, that $100 is not going to be taxed. Okay? That's pre-taxed. Put money in before taxes are taken out.
Yeah, it's not going to be taxed going in, but it's going to be taxed coming out.
Going out, exactly, right? Not going to be taxed going in, it's going to be taxed going out. That's why we have to wait until that ripe old age of retirement, right? Where we can take out the funds and then we're taxed on that money. Okay, so now let's talk about after-tax dollars. After-tax dollars means you're going to deposit whatever is left into your account after the taxes have been deducted. So if we're using $100 again, right, and we're at a 30% tax bracket, I'm just using simple math, right? If we try to put in $100, we're only going to be able to put in $70 after that 30% hit that we take. Right? Does that make sense? Because the taxes have been taken and then whatever's left, we're going to put into the account. Simple understanding. Just want to make sure we understand that. But since we have been already taxed, folks, that $70 that's in that account, when I go to retire and take that money, withdraw those funds, I'm not going to be taxed on those funds because I've already been taxed at the beginning. Okay? So I want to first and foremost make us all understand that process, just that simple formula that I used, because you have to start understanding, again, how your retirement accounts work and how taxes are going to affect the money that you take home when you decide that you want to retire. So think about it. When you grow your, what we call retirement accounts, right? Nest egg, you grow that nest egg, right? Where the growing is me depositing money into that account for 30, 40, 50 years, however long you're working, and we get to that age of retirement. If we're talking about a pre-tax account, that means we have $1 million saved. Now all of a sudden at, let's call it again, a 30% tax bracket. Now, if we take $1 million at a 30% tax rate, that nest egg is significantly reduced, 30%. we're just using simple education here, right? So you have to understand how pre-tax dollars work. Now, if we use after-tax dollars, we grow that account and we don't have to take any taxes, or we're not subjected to any taxes at that time of retirement, right? Because we've already paid those funds.
Now, why is this significant? Why is this important that we're talking about taxable versus tax-free for retirement? Well, it's because if we look at the market now, we look at the fact that the market is up and down. We look at the fact that we have a huge deficit. We don't know what taxes are going to be in the future. And even if you have, dotted your I's and crossed your T's and you have a couple write-offs, how much does it matter what your write-off is if taxes are significantly higher than what they are now? However, if you say, okay, I don't know what the future entails, and you pay your taxes on your retirement account now, at least you'll know how much money you will have in the future. That's the only conversation that we're having. We're having a conversation about tax deferred, taxable, and tax-free retirement accounts.
Exactly. And again, we're not taking into consideration, how the market's going to play. We're just simply talking about the points that we've talked about, which is just taxes. Okay. Now let's have an idea of how much of the population is contributing to these specific accounts. So we talk about tax deferred. That's the pre-tax dollars, right? Your tax is deferred. It's deferred for the future. That's what it means, or pre-tax dollars. So tax deferred accounts can be 401ks, IRAs, deferred compensation plans, pension plans, or cash balance accounts. Okay. Taxable accounts are the accounts that we get at the bank. Talk about checkings, savings, CDs, money market accounts, or even brokerage accounts, for example. And then when we talk about tax-free accounts, we're talking about Roth accounts.
401k Roth.
Roth 401ks, municipal bonds, or even what we love is the cash value from your whole life insurance policies.
Now, here's the interesting thing is that 95% of the people put their funds into tax deferred or taxable accounts, which means that you're deferring taxes to a time where you don't know what taxes are going to be. The other 5% of the people are putting their money into Roth, 401k Roths, and cash value life insurance policies. Why is this important? Is because they pay taxes now, and on whatever growth that they have in these vehicles, they get to use those funds, and they don't have to pay taxes on the growth.
Now, why is this information, again, important to you? Is because we want you to stop just for a moment and ask yourself, where are my retirement funds? Are they in 401ks? Are they in Roth IRAs? Do you understand the difference between those? And if you don't, we need to start educating ourselves on how this is going to happen, because the last thing that we want is for you to get to 65 years old and you go to retire, and now you are not on the same page as far as what you thought was about to be in your account.
Or you retired during a time where the market's down and you took a big hit on your retirement account because investments the market just tanked.
So again, we're planting the seed for you to start understanding the financial products that you're using. So what does this mean to you, and what do you do? Carmen and Darius, my money is in tax deferred accounts. The majority of my money is in tax deferred accounts. How do I then try to move those funds into something where I can now receive tax-free wealth, for example? So the idea, or at least what we talk about on the Wealth Nation channel, is we are always talking about understanding how amazing life insurance can be, whole life specifically. And cash value whole life insurance can solve a multitude of your financial needs. So for us, we use whole life insurance policies to help us plan for our retirements. You can actually hear the term in the industry called a LIRP, a life insurance retirement plan. So what we want to make sure that we can share with you today is that you can actually use whole life insurance as your retirement plan, so to speak, so that you can start depositing your income the same way that you would a retirement account and pay your premium every single year or month, however you decide to do it, and utilize your retirement account through a life insurance policy. And the best part about it is, again, we're talking about that tax-free growth, because nothing can out-earn tax-free compound interest. And you heard me say that right, because you can earn compound interest inside your whole life insurance policies. So if you want to learn more about that information, go ahead and click on the link below. We would love to serve you at the Wealth Nation.
So basically what you said goes against everything that we were taught in our industry.
Yeah.
Because traditionally what our industry says is to put as much money as you possibly can into your tax deferred account. But what we're saying is maybe you should reconsider putting up to the company match. That's what we're doing. We have a 401k Roth, and we put up to the company match into our 401k Roth. Beyond that, the difference for retirement, we're putting into our cash value life insurance policies. Now, the ones that are designed for retirement, they're designed a little differently to where you stop paying after a certain period of time. After, let's say, for example, 15 years. Let's say you're going to retire in 15 years. You create a life insurance policy where the difference of what you were contributing to your retirement, let's say, is $20,000 you were putting into your retirement account. Now you reduce that amount and you're only putting in $5 because the company matches up to $5,000 as an example. The other 10 you can put into a retirement account that lasts for 15 years, $10,000 for 15 years. And then after that, you can use those funds to retire.
Absolutely. Yeah.
Make sense?
Yeah, it makes total sense.
Did I say it too fast?
No, I think we're good. They're going to rewind back if we need a replay. But the idea, again, like we said it in the beginning, getting ahead of 99% of the people means that you have to think differently than 99% of the people. And we all got those same packets, those benefit packets that we get from our employers where we're prompted to sign up for these different retirement accounts. And we're not saying that anything is wrong with them, right? We're not harping on any of them. If anything, we're just saying, again, understand what you have in your hands. And if you don't understand it, you better go get educated.
Right. And then when you say have a warehouse facility, ideally you don't want to store your money in a place or in a warehouse where you go back to it and it's not there.
Yeah.
It defeats the whole purpose of storing your money. No, it's not a warehouse. So if we're going to put our money someplace, let's put it someplace to where it can be predictable. The retirement account attached to the market is not predictable. And if you think anything differently, then just look at the market now. Yeah. There's a lot of people right now that may want to retire right now, but it's not a good time to retire based on the market.
Absolutely.
So we're not saying to not put money into a tax deferred account. Put money into your tax deferred account, especially up until the company match, but also have some alternatives that are predictable so that you don't have so much on your
risk.
back, so much risk of whether or not you're going to have enough money when you retire, when there's vehicles there available to you that are tax-free.
Absolutely. Now, Wealth Nation, we hope that this information was valuable to you. This is a topic that we want to continue to talk about because we recognize that retirement affects everybody.
Especially now.
And if you are prepared or not prepared, we just need to start having more conversations so that we can all get on the same page in understanding how taxes work, how tax deferred versus taxable and tax-free works, because at some point, we all want to leave our corporate jobs or our own businesses or whatever the case may be, and we want to be able to have income available to us that is predictable, that is there, so that we can live the lives that we desire. So Wealth Nation, go ahead and click on that next video so we can continue to educate you on your financial future.
Remember to own your own lifestyle.
Or someone else will.